Welcome back, everyone, to Markets Live. My name is Paul Hill. I'm delighted again to be able to speak to accomplished UK fund manager Paul Jourdan of Amati Global. So a big welcome, Paul.
Thanks, Paul. Great to be back on your show.
Yeah, well, we've certainly had lots of news since we last spoke, and it's been busy so far in 2026, what with sort of fears over disintermediation by agentic AI. We've got Iran potentially around the corner. We've obviously got the ongoing conflict in Ukraine, and over the weekend, to tap it all off, we had the old tariffs going off again by Donald Trump. So putting all that together, what's your sort of outlook for small and mid-cap equities over the next sort of
the outlook for today as opposed to yesterday or tomorrow? I mean, it's swinging around wildly, isn't it? So it's probably about as confusing a world as you'll ever find, really. Yeah, it's difficult to find things to hang on to. I mean, in a way, it's quite nice to be just investing in smaller UK companies, just to sort of, they have their own micro world, and we kind of know what the problems are. But there's many really huge issues to get our heads around, and to be really honest, I think we're all still in the early stages of doing that. It's easy to sort of try and come up with insights, but the fact is there's a lot more we don't know than we do know right now on all of those things you just mentioned.
Yeah, but having said that, your portfolio has done pretty well, actually, and we've got a number of sort of questions. Let's follow. We got first one from David Raywood over the weekend. He's asking about Greatland Gold, which I think you tipped last time. It's one of these gold miners out in Australia. Clearly, the shares have done very, very well for you. What's your latest view on gold and Greatland Gold's prospects going forward? Because you've made a shed load of money.
Yeah, well, it was probably our best performing stock last year. In fact, it certainly was. And I think the gold, in terms of the gold price, I mean, this is an amazing gold price we've got to $5,000 an ounce. I know some people think it will sort of sail on up into the sunset. I'm not really of that view, but I think it's going to take quite, the best case scenario is it takes a bit of time to consolidate around this price. Can it really move a lot higher? I mean, we have to remember it is a commodity. It's a mineable resource. It's trading massively above its cost of production right now, and commodities tend not to do that for very long periods of time, because obviously eventually production rises in response to demand. And but as we know, gold is the oldest store of value in the world. It's what people buy when they're worried about currencies, when they're worried about government debt, when they're worried about war. And we've got all of those things to worry about. So you can absolutely see why gold has been driven up this high. I think it's also important to say gold is about de-dollarization. And it's about the changing world order from America being the global hegemon to China challenging it. And, America is obviously very determined that China's not going to take over, but it kind of seems a bit unstoppable. And one of China's key objectives in that process is to remove its dependence on the dollar and the dollar payment system. I mean, many people say, well, that's all well and good, but that's impossible. I think we've got to start rethinking that. China is doing this with great determination. It's building up its own international payment system. It feels only a matter of time before that will get there. And part of that move was to buy a very large amount of gold into its central bank. So that's been the biggest driver of gold last year. And that was the reason we were pretty bullish on gold all the way through this. So, I think when you get to such a high commodity price, it's wrong to just assume that it's going to plow on up forever. Well, you've got to remember that it ultimately is a commodity. Take a stock like Greatland, though. I mean, Greatland, I think, is, for me, the best gold mining company we've seen in the UK market for a very long time. It was actually it came about in a funny kind of way. It was owned by the assets they have. The Telfer mine was owned by Newcrest and then Newmont, so two majors who kind of neglected it, were never that interested in it, were going to close it, and eventually ended up selling it for a kind of closure price to Greatland, and that was really the transaction of the year last year, or I think it happened just the end of the year before, and that's what drove all the value last year. And it took Greatland from being an explorer near to a major producing mine, which was going to process its ore, to being the owner of the mine and the exploration. And so since then, it's moved really kind of quite close to its NAV, which is where it's trading now, assuming kind of current commodity prices. So where's the upside coming from? Well, obviously, with gold miners and NAV, it's all about assumptions. that NAV in our books anyway heavily discounts the Javieron mine, which they're going to bring into production. So as that comes on, that will remove that discount. And the great thing about Greatland is we have one of the most experienced gold mining management teams in the industry, and that's really what should give us a lot of assurance as investors. So we think they'll manage the transition to bringing on this big new mine in Javieron, just about 40k away from Telfer. They'll do that over the next couple of years. That will generate a lot of value in the NPV. And also the Telfer mine itself was due to close. So initially everybody modeled 1 or 2 years of production. Now they're modeling 3 from when they bought it. Net 2 years now. That's probably going to be much longer. And every year of extension to that mine life is hugely valuable to them, because it's all kind of depreciated and discounted. And veterans of gold mining will know that that's a very value generative position to be in.
Yeah. And when do you sort of obviously it sounds like you're going to run the winners, but at some point, having sort of like 5 or 6 bagged on the actual share, it becomes a disproportionate side of your client's money, doesn't it? Where do you sort of draw the line that you have to sort of take some risk off the table?
Yeah, well, we have sort of halved the position that we had, and unfortunately we took profits all the way up, which was a mistake. But we had to we actually sort of maintained the position size. And then now we've reduced it, so it became our largest position, and now it's just a kind of it's still a large position, but it's not the top holding in the fund anymore.
Yeah, no, it makes total sense. Okay, good. We've got let's move to sort of like direct carrier billing payments. I think it was your sort of top selection from last time. We've got Steve is asking about Boku. These guys sort of like help telcos manage payments to their clients, and have also added on a whole bunch of other different services like money wallets, and they've also added a subscription bundles and person-to-person payments. And I know you talked about it very highly. The shares actually have fallen a bit, maybe since we last spoke, maybe because of the agentic AI worries. I don't know. The performance has been terrific. But anyway, what's your sort of latest views on it?
I think that the shares are, markets are always about liquidity in the end. And, if you've got some holders who need liquidity, then you get quite a lot of selling. So I think that's partly what's driven some sales in Boku. It's just a bit of readjustment of the shareholder base. And there may be a bit more of that to come. I don't know. But the important thing to remember about Boku is they are working for the world's top digital online retailers. So everybody you can think of. The guy from Netflix was on the Today program this morning doing a long interview, very interesting. He's one of their customers. You've got Microsoft, Amazon, you name it. Big Apple will be there. All the big digital vendors are on the platform, and they've really built this global infrastructure on behalf of that client base, and they're the best at it, and they get incredibly good client references. So the growth is sort of should be baked into the next 5 years, just from rolling out the existing contracts they've got, taking their existing customer bases to more territories, more payment types, and they have those rollout programs pretty well established, and that's why the management team accepted an incentivization package based on the shares reaching between 500 and 900p. So to get all of their incentivization, the shares need to do incredibly well. So what's going to bring that about? Well, we are now starting to see the top line growth really come through. So 27%, and they announced in the trading update for 25. And that the big question over Boku is at what rate does that go to the bottom line? Because obviously these are incredibly high gross margin revenues. There's very little cost in the way of cost of sales here. So it's all been about at what rate Boku wants to keep expanding its cost base. So in many ways, actually, Boku should be a beneficiary of AI programming capabilities, because it should lower their cost of development. And these guys have a big development program. If they can bring the price of that down, happy days. But in any case, I think even without that being the case, we should start to see the margins really start to improve over the next couple of years, and that means finally the earnings growth will translate to EPS growth. That's what the market really loves. Even though the shares are highly rated now, I think that's going to fall very substantially over the next few years.
Yeah, I did notice. We've got, say, 20-25% top line growth plus over 30% EBITDA margins. I don't think I've ever come across on the FTSE index is a business that is in the 50% club, hardly ever on a 40% club. So 50% is very, very sort of rarefied territories. What decided that you wanted to go with Boku rather than a sort of smaller competitor, some things like Bango? Because I mean, obviously they do similar sort of things, direct carrier building and sort of bundled subscriptions, but they're in two totally different sort of like sort of valuation multiples.
Yeah, I did look at them both and decided that we would go for Boku. I think they are they're superficially similar businesses, but they're not. They're really not that similar. And Boku's ambition to become the dominant global platform for the major vendors of digital stuff, like the ones I was just talking about, that really, I don't think Bango is going to get a look in to do that. It's developing its alternative strategies, but the Boku's the one I found compelling.
Yeah, no, I think you may as well. I did actually exchange emails with the CEO of Boku. I think Stuart Neal, if I remember rightly, and he said he rarely competes actually head to head against Bango on deals. So I think you're right. They look similar, but actually they're not.
Yeah,
certainly by the performance. Okay, let's move sectors now. Bernie tells me that you've made a recent purchase of Wilmington, the sort of regulatory compliance and sort of like training service provider. They do it for sort of financial services, healthcare, and anything which requires a lot of regulation to make sure that people are complying with the laws and stuff like that. What sort of piqued your interest here?
Well, we followed Wilmington for a long time. I mean, I've known this company for about longer than I care to remember, actually. And over recent years, it's been doing something really interesting. It's shared a lot of its legacy businesses. It's really focused itself on regulatory technology, regulatory software, and training and services. And there's some events in there still. And I think that has historically been a very interesting place to focus a business on. And what's happened to them is that their rating's been trashed. And of course, this is one of the companies that's in the crosshairs of the AI storm, and the ideas going around that you want to be long hardware, short software, and that, of course, I understand the arguments for that. But I think the counter side of it, and this brings us to one of the most important debates of the day, is how is this going to play out? And of course, nobody knows the answer to that. But I have been, we've all seen in the past 20 years, all of us who lived through the markets have sort of contemplated these moments, these big moments when it looks like there's a precipice and a very binary outcomes. I think Y2K was one of those. Is the world going to end after Y2K? With the internet, even, everything's going to change with the internet. And of course, in 2000, all of that was completely correct. It's just the timing of it in everybody's mind was completely wrong. And, that sort of level of evolution, well, that level of disruption, instant binary disruption, everything here finishes, everything here starts, never really happens. The world just doesn't really work like that. And I think with this AI revolution that's going on, I think probably where the market is really getting this most wrong, in our view, is just the speed at which corporate enterprise software is going to be displaced by AI magic. And because enterprise software is not just software; it's part of the enterprise. It's part of. There's an interesting article. And forgive me, I can't remember the name of the author of an essay. He's written a counter to the Anthropic CEO's essay, who's arguing, this is all, every white collar job's going to go in the next 10 years, next 5 years, saying, well, actually, no, enterprise software is really, it's almost like a conversation. It's the way the whole thing works. And of course, eventually it can change. It's going to be pretty slow to change. And, the idea that you're going to come along running one of the world's biggest companies one day and say, okay, let's just scrap all this software we've got. All we need to do is tell Claude what we want and it will appear. That's not how this is going to work. So what is the process by which the software industry is going to evolve? And there'll be many stages to it. And in the early stages, actually, should be very good for services companies who have to then tutor corporations through how they should best adapt, how to use agentic AI most effectively, how to develop it so that it doesn't cheese your customers off, and so on and so on. And we are going to, obviously, the AI revolution is extraordinary and very serious. So I'm not trying to downplay it in any way. I'm just trying to sort of take a realistic view over how this is going to play out. And in some cases, software companies will emerge stronger as a result of AI. In other cases, they'll get blown away by it. So we've really got to tread very carefully over which is which. And Wilmington had just sold off to such a level that we felt ahead of its results. Got results, I think, next week, maybe even this week. I think they actually brought their results forward a week, which is quite interesting. How many companies do you know that bring their results forward a week? Well, it tends to be those ones who are desperate to tell the market what the results are, right?
Yeah, that's usually you're right. That's usually a good sign. I did see. I mean, they're trading at about just over 11 times PE and 6 times EBITDA, and I don't think I've ever seen it that cheap for this sort of quality company. And you raise a really good point, because I would put sort of like Wilmington and other these sort of regulated service providers in the sort of the users and beneficiaries of AI, because it should, in theory, reduce their cost base. But assuming that their clients don't get totally wiped out, which is usually hopefully they're doing on a one-to-many model. Hope that won't happen. Then actually on net they should see reduce certainly a lot better margins, because their cost base can be certainly repositioned, and the quality of their services can be improved, I would have thought, for a lower cost count.
Yeah, I mean, I think all of those things are correct. And actually, Wilmington's business, there's many different types of companies in there. Maybe one or two of them will get hurt by AI. I definitely don't think they all will. For some of them, it'll be an opportunity, but also this is also to do with the pace of change and Wilmington's ability to adapt and keep on top of what's happening. We just took a view on it and felt actually this is a moment when it's gone way too far, and directors have been buying stock. They're obviously very keen to tell the market their results. They just made a really big acquisition in Spain, which the market didn't really like, but actually will be earnings enhancing significantly. So, so we took a view on that one.
Yeah, and there's M&A, isn't there? Because I think Marlowe got bought out by Mighty, and Marlowe also sold was it Data? I think it was Global Data. It was one of them, anyway. Also sold out their division and their compliance division for about 20 times EBITDA till 2 years ago. So you're right, big valuation upside. Okay, let's move in. Stay in the software sector. We've got Accesso, which used to be a sort of like a real poster child of all things sort of like AIM software in the theme park and amusement sort of sector. Its big clients historically have been Merlin with Alton Towers and Cedar Fair in the States and Six Flags, who I think got together and merged. Anyway, they came through the pandemic pretty well, which is good. They were growing, made a couple of acquisitions, and they're now currently going to do a tender offer of about £14 million at 300p, I think. But they have had some bit of a sort of churn in their base with 2 big contracts. What's your latest on this one? And do you know why they lost those 2 contracts? Because it's pretty unusual for this sort of stickiness of software.
It is, and I don't know why they lost them. But what I would say is that over the years with Accesso, this will be their theme park operators, and over the years we've seen some really weird things happen with theme park operators, and they are slightly quixotically run in some cases. And if you follow the fortunes of Six Flags, it's been a bit of a mess, and it's had various different management changes, and they come in and they sometimes do crazy things. So I don't know fully what's going on. And clearly, there was one they lost, and then it's come back again for a year. And the reality will be for some of these theme park operators, they might try and move somewhere else, but it's pretty difficult. And then if you suddenly find you've got lower revenues, what are you going to do? And I think the value that Accesso generates for its customers is pretty good. So those that are moving on, well, that's interesting, and we'll see, do they come back again or not? So, more will be revealed when with the company, and I'm sort of overdue a catch up with them. I do think that the shares have fallen to a slightly bonkers level. You've got well over $100 million of gross profit in this company, and I think you've got what is it, 110 million market cap in pounds, and they're, you shouldn't forget that they're spending something like $25 million a year on development. So, that's a lot of money to be spending on developing the technology in the business. But they have, obviously the obvious worry with Accesso is that the US theme parks are going to be hit by effectively Donald Trump killing off tourism. And I've been worried about that for a year. And, we did lighten up our position in Accesso over that worry. And in some ways, I was amazed how well they did in 2025. And they got to the end of the year with a reasonably positive trading update. That's quite something in an environment that is as tough as you're ever going to see in the leisure business. And obviously, it's a global business, but the US is big for Accesso. So I think they've done pretty well through such turbulent times. The tender offer is a big expression of confidence in the business and just how cheap the shares are. So it's management telling you, well, if we can buy all these shares at 300p, that's brilliant for the business. And I think they're probably right, to be honest. So we've got a dilemma to think about: do we take part in the tender offer or not? And that's something we'll work out in the next week or two. It's not a totally obvious. There's no totally obvious answer to me. I think it's probably good for the company to be buying them back, but there are clear risks over the leisure industry in the US. I guess it's like anything. We see a lot of very violent images from the US. That's obviously not the whole country. And it's like when there were riots in the UK, the Americans were watching pictures of the riots, thinking the whole country was dissolving here. My cousins in the States tell me that actually, you try and go skiing in the States, everywhere's full, and Broadway is bustling and absolutely thriving. So it's a very strong economy. We mustn't forget that in the US. And what's happened with the tariffs, even though it's nightmarishly, nobody has a clue right now. Are there tariffs or are there not tariffs? Are there refunds or are there not refunds? But if there are refunds over these tariffs, that's a massive stimulus to the economy, and the US is likely, it could even overheat on the back of it. And who knows where Donald Trump's flailing attempts are going to be to get new tariffs in place. Do they work? Do they last more than 150 days? Just so many unanswered questions. But bringing that back to Accesso, I just think we've got to pay attention to the valuation, which just looks completely wrong down here.
Yeah, no, I would agree. It's sort of like 10 times or 11 times PE, and I think it's 0.7 times sales. It looks absolutely bonkers. I guess the key question, is it a value trap or is it a value play, comes down to whether they are losing their competitive moat, and it's understanding why they lost those two big contracts. Because if it's just sort of like, I don't know, distributor or reasons out of their control, or they've just decided to do something that isn't anything to do with their competitive advantage or competitive loss of competitive strength, then I think it's probably it's a value play, because they should be able to reinflect the sales growth higher. But where any investors, I can see the sort of the concern, because where you see on a high margin software company sales decreasing, then that has a disproportionate effect on the bottom line. So when you do find out, I'll have to pick your brains, or even if Steve Brown I think he's the CEO of Accesso, if he's listening, he can potentially let me know, and I can
absolutely. Well, if you hear first, let me know. But yes,
I will do. I will do. Okay, brilliant. Let's stay in the sort of software sector. We've got Kainos, which I know we chatted about it last time. This basically is a Workday services and products company, and not only implements Workday, which is a HR, finance, large sort of like software developer in the States, into the European and UK customers and stuff, but it also adds its own software overlay in the products, which was an incredible story that you told me that they're doing really, really well. Plus they do IT digitization. Anyway, they've been really caught up in this whirlwind of concern about agentic AI, I guess because of Anthropic's plugins and undermining the products, the Workday products division. But how do you see it?
Yeah, and I don't necessarily think the initial worry is over Workday products, where it's going to be a very long time before Claude can just come up with new Workday products better than Kainos can. I think there seemed to be more of a worry over IT services. So people were thinking, well, why do you need consultants if you can just tell Claude AI what to do? Well, in the enterprise software space, we are just a very long way away from that. And clearly we're still at that moment when to use Claude AI well, you've got to be a programmer already, and you've got to be very expert. And when it writes you software, you've got to be able to critique it and improve it and check it. And all of these considerations will be good for the IT services side of Kainos, who have exactly those skill sets. So I'm still envisaging that certainly the first phase of the next phase of AI development will be pretty good for Kainos. And then this this much longer term worry over, well, what happens down the road when robots rule the world? Well, I don't know the answer to that. I mean, I don't really know how to deal with it, and how does a business like Kainos adapt and evolve during that process? Well, I think it stands as good a chance as anyone of adapting and evolving well. But right now, you promise you can't argue against an argument which is in the sort of slightly science fiction future. So what happens in a world when this stuff is so good that we don't need anybody anymore doing anything? I mean, but how do you argue against that? You can't really. But all you can really say is, well, we can only deal with what we can see in the next 3 to 5 years and how the world works as we know it now. Yeah. And in those respects, Kainos, I think, will do very well over the next 3 to 5 years. And it's very well suited to how the world works and adopting these new tools and helping enterprises who want to adopt them. But in particular, continue to help governments. In the UK, they're a big supplier to government. Government needs to has a lot of IT projects. Contracts are coming through. They clearly need to spend a lot more on digitization. Incidentally, I was sort of amazed they dropped the digital ID policy that they brought in.
The 15th U-turn, you mean?
I think, yeah, whichever number that was. I mean, it was somehow the idea of a digital ID was, I think, it's supported by 50% of the population before they brought it in. And as soon as they brought it in, that number dropped, and somehow they managed to say, we're going to do this, and then they completely failed to argue correctly for why we need it, and so then it became unpopular. But actually, that would be a very helpful thing to have. But there's many other things that government needs to do and can really, it's money very well spent by government. I think how easy it is now to do a tax return online. Thank goodness. Or to get your driver's license or to renew your MOT and all of that. It's the digital government is making all of our lives a lot better and making government better. So there's much more to come on that front. Workday, the Workday business, Workday, the growth in Workday itself has slowed down, and that's been one of the factors dragging a bit on Kainos. But actually, their products division, I'm pretty optimistic about still. I think that should do very well.
Yeah, if you actually, what's quite interesting, if I overlaid, which I won't, but if we overlaid Workday's share price here, it's the same sort of thing. I think peak to trough since really roughly around about December, it's come off 30-40%. It's been one of the worst out in the States of those SaaS firms that have been absolutely decimated. And so I guess when it comes to their Workday products, is the sort of obviously I mentioned the fear that you potentially being taken and replaced by these plugins, but then again, putting the other boot on or the other sort of like looking at it from a different angle. If I was the CIO of a large corporate and I had Workday, would I trust my own employees to use sort of like external software plugins to do day-to-day activities, or do I want to go for a secure, well-respected supplier like Kainos to do those plugins? Is that the sort of the argument you're doing? It's basically that security that you don't want to get your whole system infected by cybercrime.
Yeah, there's not a chance, not even the tiniest chance you get your employee to get Claude to just draw something up for you and then plug it in. Yeah.
Okay, good. Let's move to another sort of like really deep vertical software company. Got Alfa Financial, which I think is probably the world's leader in sort of software for asset finance and car finance, PCPs in the UK. I think the US now is its biggest area. Its cloud offering is going from strength to strength, I think, as they try and push everybody to a one-to-many type model. How do you see this one going forward? The shares obviously have done pretty well over the long term.
Yeah, and it's been a highly rated company, but it's justifiably so. And actually, we think that they should be in a pretty strong revenue growth period right now, and that we should also start to see that translating much more to the bottom line than it has done over the last couple of years, because they went through a big reinvestment program over the last couple of years, and that meant that the top line growth didn't come through at the bottom line. So because they were plowing the money back into building the cloud version and if you like, updating the platform they've got. But as the growth accelerates further, I think we will start to see that come through, and that should be very positively received by the market. And Alfa Financial, in many ways, it should be a classic example of a very entrenched leader in the software, enterprise software field, where this is going to be very difficult for AI systems to come along and just sort of devalue. So yeah, I think this will be a pretty sticky business and a sticky piece of software in its industry. This has great complexity over what it does. It has to have 100% reliability. It's based on a huge amount of industry knowledge and expertise built up over a very long period. So I think it's a classic bit of enterprise software that should be around for a long time.
Yeah, and I think a lot of sort of 40-50% of their revenues are implementation, aren't they? So it's customization, and I mean, it just shows the sort of the barriers to entry are huge on this, because everything, they have one core level of software, but essentially it's sort of like tailored, isn't it, to that individual customer, and they'll never find anybody doing it the same.
Well, that's true. Yeah.
In theory, anyway. Okay, let's move to another one in IT services. Basically, ID location and identification. We've got GB Group. We've got Kate. She's asking about it. The shares have really been hit hard of late by the fears over agentic AI. I think they've got the market overall is growing at sort of like high single digits, low double digit type organic growth, but GB Group hasn't been able to do that sort of low single digit growth, largely because of their US business that is going through a turnaround. How do you see this one going forward? Is it going to be able to get that inflection of the top line back to where it was, which is sort of like a lot faster organic growth?
Yeah, I mean, that's a really good summary of where the business is up to. And it is all about, well, a big chunk of this is about getting the US business back to growth. I mean, that's obviously been a key task of the newish CEO. It's been there a couple of years, but yeah, that's absolutely top of his agenda. The company spent a lot of money on restructuring the business and has put a lot of emphasis on GBG Go, which is effectively their integrated platform, which they're taking to market now. And it should really simplify the sales operations, should save costs in the business. I think they haven't yet closed down their legacy platform. So as they do that, and assuming they do that over the next few years, that should cut more cost out of the company. And we need to see two things really. We need to see really good cost discipline, which, to be fair, I think they have been good at, but there's more they can do on that front. And GBG and other businesses we'll talk about today too should really be able to profit from efficiency gains from AI, assuming that they are there. If they do start coming through, that's good news for them. They should be able to get the cost of doing what they need to down. And then we need to see them starting to hold their own in the US market and grow at least in line with the market, and maybe start to take back some market share. And I think one of the areas maybe worth just touching on with these kind of IT companies is there'll be a lot of scrutiny over the level of data held in a business, and to what degree can a company make data proprietary, and therefore AI is no good if your AI software doesn't have the data. You can't ever replicate the same thing. And so far, the fraud and identity verification companies haven't really had a lot of proprietary data because it belongs to their customers and they get sent all the data, they analyze it on behalf of the customers. But within GBG, there is the new product that I'm most sort of, in a way, hopeful about in the medium term for the business, is where they're getting their customers to agree to cooperate over data, so that if there's a fraud detected in one bank, actually all the banks know about it. And it's a very, very logical place to go, and they need to win the trust of their customers to do it, because at that point GBG becomes the owner of proprietary data. And it would also mean that because they are the largest in the world of what they do, even though it might seem crazy because it's a relatively small company, but these are niche areas. That would put them in a very, very strong position, and so it's what I'm hoping will generate value for the business over the next 3-4 years, is the evolution of that, winning the customer's trust, getting them to share data, and for GBG effectively to become the platform which becomes the most accurate and most efficient way to detect fraud and protect transactions.
Yeah. So you basically, even though the share price is going down, it appears as though, because they've got these new products coming in and the way they can use AI, their actual competitive edge is increasing. It just hasn't flowed through to the numbers. Once GB Go and this potential opportunity in terms of the sharing banking data and stuff like that, it appears from your understanding that actually their competitive advantage or their competitive positioning is actually increasing. Do you believe? Yeah.
Well, I think that could well be true. And obviously the market is just being very knee-jerk and just saying, well, Claude AI can do all of this. Why do we need GBG? That is, just to call it a simplification is a massive understatement.
Yeah.
Who's going to be best used at the moment to use AI tools to make what they do better? And then there's this chat about, well, will a native AI company be better than what these guys can do? I'm not totally qualified to answer that question, but I don't see it right at the moment. But clearly, the market's sort of asking those questions and just selling. Maybe this is almost like automated. Oh, it's a software company. It's UK. Let's just sell it and buy some hardware. Well, that's all well and good, but these things have sold off to slightly crazy levels, I think. So
no, they have. Yeah, I mean, they're absolutely so cheap. It's incredible. I haven't seen it for such a long time. And if you're sort of like arguing the bull case as well, because of the proliferation of AI and certainly the impersonation, I mean, it's very easy now to sort of like just scrape somebody's voice and image and almost do a perfect match of somebody. So there could well be a lot of additional use cases for ID verification,
exactly.
Regardless of just your exact, your normal sort of passport and your driving license and financials. It could go everywhere. That everybody needs to know that this actually I'm dealing with the right person.
I completely agree. I mean, who's going to be best placed to use AI to catch AI? Is it the existing companies who've already got all the plumbing, who know how know everything about the current state of the market, or is it going to be somebody completely new who has never done this before? Well, my money would be on GBG and its competitors.
Yeah. No, fascinating. Great insight there, Paul. Okay, let's move on to another one. It seems to be a train of companies that have been caught up in this AI mix. We've got Gamma Communications, which is a sort of like a sort of telco software services communications provider for lots of corporates in the UK and out in Germany. It does things like broadband, telephony, IT services and all kinds of stuff. But the shares, unfortunately, used to be a darling, but it's been one way down over the last, certainly over the last year or so. How do you see this one? Is it? I know it's just moved to the main market. Is that going to be the inflection point that we're going to start seeing some like-for-like growth?
Well, I mean, its move to the main market was a spectacular failure, and as are most of the moves to the main market. I mean, I honestly don't know why any company is wasting money on moving from AIM to full list. And times like these, it's really, it's just a total waste of effort and time from my point of view. And I've said that to many companies: don't waste your money; it will achieve nothing. And it applies to GBG as well. They also moved, and Gamma moved. These things were, for me, deeply annoying that they did that. But we've got to remember that this is also sold off with AI, and I'm not quite sure what it is people think AI is going to do that replaces Gamma, because what Gamma does is telephony and communications. It's in the name. That requires infrastructure and pipelines and software. So I think their value offer is very good. They suffered on the back of the UK economy being so slow, and the promised growth that the new government was going to make its number one priority turning out to be priority number 25 somewhere at the bottom of the list. So UK growth hasn't really materialized, and that's put a bit of pressure on their UK business. But it's a telco. So what's remarkable about actually many of the companies we talked about, but Gamma, GB, Accesso, Kainos, these companies generate a lot of cash, and and that's but certainly very true of Gamma, and it has a very strong balance sheet already. So one of the big themes about the companies we're talking about today are they're doing buybacks, they're doing tender offers all over the place, and that's because it makes massive sense for them to do. Their shares are so cheap. The best thing they can spend the money on is buying their own company. And so that's a huge theme in the UK market. And what Gamma's doing in Germany is, I think, absolutely not in the price in the business. They're establishing a market-leading position in SIP trunking in Germany, and Germany has been very slow to adopt online telephony. Amazingly, I think probably most people on this call will be using online telephony almost 100% of the time now, apart from mobile calls. In Germany, that transition has been really slow, so they've got this untouched market to go at, and the growth already in the first half of 25 is very strong. We're going to get we've had the trading update, I think, for 25, the full year. It's good, so what's not to like about it? I don't know. It just seems crazily cheap.
Yeah, I think it's got caught up in that whole sort of like it's probably in some sort of like basket of shares that sort of software and services and all that kind of stuff. But let's move let's go to the power sector, electricity. We've got U Group, which provides business to business energy services in the UK. Also does sort of like meters and what they call basically power generator, electricity, gas, and stuff like that. Its shares have done pretty well actually of late. I'm not sure why. Maybe we just sold off. But how do you see this one going forward?
Yeah, I think this is a really interesting situation in U Group. I'm a huge fan of this company, and I sort of reconnected with the CEO last year, and one of the quirks about it is that the CEO, he's a lovely character. He got very fed up with the market, and he can understand why the market sort of wouldn't give his shares a proper rating. And the shares have done well, but the shares are not on a proper rating. That's my starting point here. And it's a control company, so he still owns over 50% of the business, and the market doesn't really generally like that, and it's maybe a little bit illiquid. But what's been going on under the surface with the company? Back in 2018, they had a big accounting scandal. Really, they had to restate their accounts. I lost money in the company then, and I sort of walked away from it and thought I'd never, come back to it. But then you got to keep an open mind as a fund manager, and what the company did over the next 5 years was really remarkable. And so, on the face of it, they're just an electricity and gas supplier in the UK. You might say, well, what's interesting about that? Well, they only supply businesses, so it's a pure B2B supplier. So it's not a competitor with most of the household names in the sector, but some of whom do have B2B units, but that's only a part of their business. And what he realized was that what he has realized and what he's built in this company is the way you compete in this market is you need the best systems. So actually this comes down to software again, and he's invested a reasonable amount of money in building very smart software systems, which means when a business rings them up and says, okay, I've got 50 sites, these are my 50 addresses, 50 meter points, give me a quote for a 5-year energy supply contract, 3-year energy supply contract starting from next week. How many competitors can really do that? Well, he can provide that quote within an hour or less because he's got the system to do it. Whereas a lot of the competition has to go around and say, okay, well, that will take us a couple of weeks to work that out, and we'll get back to you. And so in a way, in a very sort of simple, by building a fairly simple technology advantage, he's capturing really rapid market growth. And they had a trading update in January, which didn't say a lot. You might say, well, it's a bit under communicative, but what it did say is that their meter growth rate was 48% in 2025. And that, when you think about it, that's pretty astonishing. And here you got a company with actually pretty much for the first time in its life from about 6-9 months ago, it has a very strong balance sheet. So it's starting to generate cash really significantly. You don't just look at the cash in the company. So the company will say it's got, X amount of net cash. What you need to take off is the line in the balance sheet, which is for ROC payments. So it's like VAT, but they only pay it once a year. So they build like this big ROC debtor on the balance sheet that has to be paid. So just take that off the net cash.
Those are renewable carbon obligations, aren't they?
Yeah. So customers pay them, and they keep the money and then pay it to Treasury after trial, in August every year. So they build this big rock debtor, and you have to take that off the cash. And if you do that, you see they're actually, some point last year, their cash went from kind of 0 to 40 million, and then it's gone up 55 million net, and that's completely transformed. This business has never had that strong a balance sheet in the past. When you deduct all the things you need to deduct, and I think it's really transformed it. And I think me and some others have tried to buy shares from the CEO. He wouldn't sell us any. It's kind of really annoying, but such is life. But I kind of get his point in a way that actually you really don't want to sell the shares down here. This is still on a P of, what is it, 8 or something, or and this is a genuine growth company paying a nice dividend with a strong balance sheet. It's the kind of thing we absolutely love.
Yeah, it's Bobby. Is it Bobby Callar or something like that?
Yeah.
Is the CEO? Yeah. I mean, to be very honest, in 3.5 years to 10 bag is for a sort of energy supplier is unbelievable.
Don't be to look backwards in this company. You think, oh well, I'll wait for it to come back. That's I think this is only just getting going, really.
Yeah. Okay, let's stay in the energy sector. Let's go to oil and gas. We've got Serica Energy. Basically, these guys are sort of like one of the. I think they sort of produce about 5% of the North Sea oil and gas for the country. What's surprising here is that the oil price has actually gone down heavily over the last year, but their share price has gone from about 120 to £2.30. So what's happening? It's the only sort of like oil and gas company that's done it, I think.
Yeah, I don't know. I haven't looked at all the comparators to know whether that's the case. There's a few cross currents going on with Serica, and in fact, as with most oil companies, but they had a very poor year of production. They had a troubled 18 months in production terms since they bought a company called Tailwind, and that came with the Triton hub, and they had all kinds of operating issues with it, and so it's underproduced, and the cash flows were a bit disappointing, and they went into net debt. But actually, in some ways, when that happens in an oil company, what you're really doing is you're deferring your revenue from one point to another. And I suspect the management team are not too disappointed with having deferred a lot of revenue from the past 18 months, which have been rubbish for oil and gas companies, particularly in the UK, to some date in the future. And now we've already got a higher oil price, which, to be honest, I wasn't really expecting, but it's really interesting that the oil price has picked up. So that's one cross current, and that's why the shares came off a lot. Poor production. Why have they gone up again? Well, the production will get fixed this year. I think it was, what was production last year? Maybe 25,000 barrels a day. That should be well over 40, maybe 50,000 this year. It can get to 65 on what they made some acquisitions on what they've already got. Can get to 65. That's a massive delta. And the other thing that's going on, which affects all of the North Sea players, and Serica is one of the few completely pure play North Sea players, is of course what's going on with the EPL, the windfall, the so-called windfall tax, which was still applying when there was not just no windfall, but we had one of the, an incredibly harsh oil and gas price environment in the UK last year. And the government doggedly said, oh no, we need to keep on with this windfall tax. I mean, even though the absurdity of it, to anyone who really understands the industry, it was just kind of mind-boggling. And then what happened was, I don't know if maybe you already know about this, but this is a kind of not very well kept secret in the industry, is that in the run-up to the budget, the oil and gas industry was kind of assured that the government was going to bring in the new long-term version of how this tax is going to work. Because they did a big consultation last year, and they devised a new tax which would basically inflect up and down with the oil and gas price. And it's exactly the right way to do it. It's what we should have had 40 years ago. A lot of countries in the world having gas tax rates that move up and down. Then you don't need to change it. And that's why the UK has kind of trashed its reputation over becoming one of the worst least reliable tax jurisdictions in the world, because it had just a really duff tariff regime in tax regime in the North Sea. So they kept messing around with it, which was crazy. And there would be a lot of reputation to be salvaged by bringing this sensible regime in and having devised it Why don't you bring it in now? And it's screaming out as the obvious thing to do. It would also it would help avert the decline of the industry in Aberdeen, which is acute at the moment. The number of job losses is phenomenal. The government's in denial about it, but we'll come back to that. It's too detailed for now. But anyway, before the budget, the industry was assured that they were going to bring in the new regime and scrap the old one from now, which was just a no-brainer thing to do. It would have actually increased government revenues to do that because the industry would start investing again. And then 2 days before the budget, they changed their minds. So that announcement we had in the budget where she didn't change anything, that was only decided 2 days before, having really not been on that tack. So obviously it feels like that was just Ed Miliband's intervention. He stopped it from happening. He's got very ideological and completely barking mad views on energy policy, and is given how strategic energy is for the next 25, 30 years, what we're doing is unbelievable insanity. And there's no other country in the world that's closing down its oil and gas industry. Actually, Norway, I just read today, is producing more oil and gas than I think it ever has done in 2025. And every time I read another country, they are pushing to expand their production. There's no particular shortage of oil and gas. So it's a competition for producing in your local market, using your own oil and gas. Trying to cut production that's somehow good for the environment is an argument that makes absolutely no sense. It's actually not good for the environment because you just end up importing much more carbon intensive oil and gas. It was never linked to using less of it anyway.
Yeah, that's what I think there was a report, wasn't it? Was it about a week ago from the Tony Blair Institute, the ex-Labour Prime Minister, who was castigating Ed Miliband's policies in the North Sea, saying not only are we losing lots of tax revenues and jobs, but we're not helping the environment one bit by doing this policy. But I think you're in good company.
Tragedy is that it's kind of given us the highest power price in the industrialized world, and yet we've done nothing for the climate. It's a great tragedy, really.
Okay, good. Let's move to, we've got property, residential. We've got Grainger. Sophie, she's asking about it. This is the biggest, essentially, landlord of residential property in the UK. It's doing build to rent. It's got a big pipeline of properties that it's building, constructing out over the next few years. It's just moved to become a REIT, and to fund that, it's selling off its tenancy properties, which are sort of protected, long age type properties, and they revert then to open market sales once the tenant actually dies or leaves, etc. How do you see this one going forward? The shares are pretty much, I think they're about 30% below net tangible asset value, or EPRA net tangible asset value.
Yeah. I mean, it's a very straightforward company. It's done a good job of migrating its business to build to rent, as it's called, and they are a great developer of build to rent sites. So they build the whole block, and they build properties that are intended for rent rather than for traditional residential. So, and then often intended for young adults sharing flats. So they don't build the classic kind of master bedroom and then tiny little box rooms. They build rooms the same size so that they're shareable. It's just sort of sensible things like that. They might have a gym in the basement, and very attractive places for young professional renters to live. And they've done very well on it. It's a very it's a simple business. They're good at what they do. There does seem to be a pretty big valuation anomaly, which has persisted. There's definitely a possibility that somebody who wants to get into build to rent comes and buys the company. Be a very smart way to get into the sector. And in the meantime, they should carry on generating some value from developing new sites, and they have a good pipeline of those. So very simple business, good rental growth in their properties. It's been a bit beaten up by the general aversion to the real estate sector and to interest rate rises. So if we get some more interest rate cuts this year, should be very good for Grainger. Okay,
good. Let's move to airlines and leisure and transport. We got Jet2, which used to be, I think, the biggest company on AIM a long time ago, but now it's Greatland Gold, I believe. So you've done pretty well with your choices. But anyway, the shares, unfortunately, have come down a bit now. Very, very cheap. How do you see this one?
Yeah, I mean, Jet2, it's such a good operator. of its assets. It has a slightly aging fleet of aircraft which is renewing, so there'll be a big renewal program over the next 10 years. But you kind of own Jet2 just on the sheer quality of the way the management have run it and built up this great holiday brand, where once you've been on a Jet2 holiday, you're pretty likely to want to do another one because you get treated very well on it. And riding on a Jet2 airline, I haven't done it for quite a few years, but it's a very different experience to going with a traditional low-cost carrier. And it's they've done that without making it a high-cost business. So they do it in ways that probably don't cost huge amounts of money, but make a big difference to the customer experience. They've been punished really for two things. One is the tendency in the market for later bookings. So that is meaning they don't have the visibility that they had in previous years, and that applies to all the companies in the sector. But that's not yet translating into lower business. So people are booking; they're just booking later, and so that's penalised them a bit. The market didn't like that, and it's created a bit of uncertainty. And then the second thing was obviously opening a Gatwick base, which is an investment, and actually probably quite a long-term investment for the business. Obviously, the right thing to do for the company, but in the short term, you don't get the sugar rush of additional earnings. You get a bit of a drag, and so the market didn't like that either. Neither of those two things are really problematic for the company in the medium term, and it's a little bit childish of the market to have taken so much against both of them.
Yeah, it's only about 6.5 times PE, so it's very, very, very cheap. Okay, let's go for a special situation. We've got Big Technologies. Alan's asking about it. Now, they've come through. These guys basically do the sort of like almost like best-in-class electronic tagging of prisoners at home, so the ankle bracelets, etc. But they've had over the last 18 months some ongoing litigation with previous shareholders of a UK subsidiary, which is now finalised, I believe. But they paid basically compensation of about £38 million to those guys. That's finished, but now they're in the process of trying to reclaim that from their ex or former CEO, Sarah Murray. How do you see this one going through? Is these sort of like the Damocles sort of litigation largely solved? It's just as in such that it'll be sort of extra on the way back, sort of like if they get whatever they get. But anyway, how do you see it?
Yeah, no, I mean, what you said is exactly right. So the thing which was a fundamental risk for the business, which was the case being brought against them by the former shareholders of the business, that had to be sorted out. And until that uncertainty was removed, this was a very difficult story. So having got that agreed and settled is a big deal for the company, and was very, very important to do that. It was probably a lot more expensive than one would have reckoned a few years back. What everyone was told was a kind of nonsense case turned out to be a very real case, and therefore it had to be settled. And so now the litigation is kind of all upside for the business, and to what degree can the company pursue Sarah Murray to get a good settlement? And I think the important things to note here is that one of the big outstanding issues is, well, what happens to these trusts who own something like 22% of the company that turn out to be controlled by Sarah Murray allegedly, which for a long time she maintained she didn't control. Actually, the current status of them, so I understand, is that they've been frozen, so they're not able to vote their shares. And actually, one of the really good things that could happen here, and the one possibility, is that the shares in those trusts end up getting cancelled, and that would obviously be brilliant for shareholders, because it would start to fundamentally alter the shareholding dynamic of the company, but also clearly it would be 22% enhancing for all the other shareholders of the business. So that's definitely something I'd really like to see happen. Whether it does happen or not, obviously I don't know. And then there's litigation. Is there a case for Sarah Murray having to bid for the company? It's maybe, I don't know. That's been raised as a possibility. Probably unlikely. But is there a settlement to be reached? Well, absolutely. I would hope there is. and there should be scope for some financial compensation to the company as well. So we'll see. I think it's all kind of all upside. And in the meantime, what we really need the business to do is to get back to selling, what is a best-in-class product globally, and a really, important tool for modernizing the whole prison system, and making much more use of home tagging, which I'm really convinced we use as the front line of incarceration should be in someone's home for short prison terms. Why would you not do that? And somebody can stay working. You save £50,000 a year for the taxpayer. You don't get them. You don't criminalise young people who've committed an offence. By if you send people to prison, you're probably going to criminalise them for life. So I think it's something we should make much more use of. But the government doesn't do it because it's bought a much inferior system for reasons that remain a complete mystery to me. And maybe it's just because I don't know enough about the industry, or there's something I've missed. But I know the government got very fed up with the system that they bought, because it can be cut off, and and perhaps if I'm wrong, it's because I'm buying the big technology propaganda too much. But it certainly seems from what we've been able to find out, that they have the best system. It feels like the system that should be much more used than it is. So really, there should be a growth business in here waiting to get out once these distractions over litigation are out of the way. And maybe it requires a little bit more management rejigging, just to kind of get the business really focused for growth on what it's got, which should be very good.
Yeah, well, you never know. We might even see an ex-member of the royal family having an ankle bracelet, or potentially the UK ambassador to the US having an ankle bracelet going forward. That would be certainly a first, to say the least. But that's obviously going through the police investigations. Just in terms of the timescales for the Sarah Murray sort of settlement, any sort of views on when that may or might not? Is it really just up in the lap of the gods of what Sarah wants to do?
I mean, that is in the lap of the gods.
Okay.
It could actually go to court.
Yeah.
So if it goes to court, it's a long timescale.
Okay.
I don't think it'd be in either party's interest to go to court. But on the other hand, if Sarah Murray doesn't want to reach a settlement, or if we can't agree a settlement, then they'll have to go to court.
Yeah, okay. All right, okay, well, let's move to the final one. We've got Trainline, which is basically the sort of like the UK's biggest sort of tech-enabled travel app, I guess, but really for trains and for all kinds of different transport in the UK, but also increasingly abroad. We had a very heated debate last week in terms of whether this was a value trap and a value play. Could you take us through what you see from the company?
Yeah, it's So, okay, well, what do we see? So what do we know about the company? Well, it's a pan-European leader in train ticketing. And it's actually weirdly slightly active in Japan as well, I understand. But, it's the market leader. It's the best-known brand name. It has the best app. Has a lot going for it in the UK market. Part of what it's been able to do that is to do split ticketing, where it's had certain it's been able to do split ticketing incredibly effectively. Some of the competitors have caught up, but in this business, people don't want to have lots of different train ticketing apps on their phone. When you want to buy a train ticket, you normally want to do it pretty quickly. You want to be pretty confident you're going to get the best price, but you want convenience, and you want the thing to tell you through the journey: is the train late? What platform is it coming into? If I need to change, can I change? Everything. So having a really slick, 100% reliable app is very, very important. That's what they've got. I mean, I think that in a way, the tragedy of Trainline situation is that we've got to say, some governments will understand that they should promote national business champions. And if you've got a business which is one of the leaders in its field globally, you might think actually you should look after that business and try and accelerate its growth and help it get into new markets, not go and compete with it in its home market and try and undermine it fundamentally. Why would you do that? And so, the likely scenario is that when GB Rail buys it's talking to who it should buy its app from, it's going to almost certainly commission a foreign company to develop the app for it. Australian, or I can't remember the different nationalities. One I think is Israeli, one is Australian. There's another one somewhere else in Europe. It's, they're almost assiduously going out of their way to avoid actually boosting the UK champion of this industry. And Trainline has massively improved the experience of rail transport in the UK by what it's done, and everyone else has had to keep up with it. So where's this all going to go? I mean, I think what's likely is that GB Rail will probably be late developing an app, because government's not a very good buyer of these types of things. Having said that, if they do it the sensible way, they won't spend too much money, and they'll just, if you like, re-platform one of the existing apps, probably the LNER app, and get that redesigned. But if they try and do it root and branch from the beginning, that would be incredibly expensive. And then it's sort of the degree to which the way this plays out will be the degree to which they kind of play dirty in a way, and do they try and get advantages for their own app, which are sort of unfair advantages. And what happens to split ticketing is a really important point, because at the moment the LNER app doesn't do split ticketing, whereas so that's why you probably almost certainly be better off using Trainline most of the time. It's very difficult to engineer out split ticketing from the system, and they've tried all sorts of ways of doing it. One way they've tried actually is by restricting the number of times that an app can query the database to find out what tickets are available. And that actually then hurts a lot of the smaller apps, because Trainline have so many inquiries, they can cache a lot of the inquiries and therefore make very good use of each inquiry they make. But for smaller apps, that's very destructive. So look, this is a really it's an unpredictable dynamic. What I think about Trainline, though, and I want to have this conversation with their management, is that they have 600 developers in the business, and they have a cost base which is like this Rolls-Royce cost base. And actually, for me, the best way the company can start to heal their current situation is to effectively use AI to cut their cost base. And in the last call, they said, well, we're going to use AI not to cut the cost base, but just to do more. And so my answer to them is, well, actually, that's not the right thing to do in this situation. Listen to what the market's telling you, cut your cost base significantly and use AI to do the same amount. And that would be very value generating for the business. And this business could then generate, it already generates a lot of cash, but it could really accelerate the cash generation. And I think the market would respond really well to that.
Yeah. No, I think you're right. Yeah, and I think in the fullness of time, actually, I mean, you could find, if once you do have the sort of the ultimate position of Great British Railways, they could basically remove split ticketing in total, because you wouldn't need it then, would you? Essentially, because you'd have one body doing across all the actual train line. In theory, you wouldn't need split ticketing unless you go from different sort of form factors to into transport. Basically the tube to rail.
Yeah, I mean, they're very reluctant to lose the right to charge more for the most popular journeys. I mean, I don't know all the ins and outs of split ticketing, but my understanding is they're not that likely to remove it,
right?
Or to fundamentally reprice everything like that. But maybe they will.
Yeah.
And those split ticketing calculations involve a very, very scary number of different possibilities. It's in the kind of millions or even billions. It's pretty staggering how what goes into producing them. So but I haven't heard that they're going to remove them. But who knows how this plays out? But, whatever happens, Trainline is in everybody's pocket. It's got by massively the most dominant share. It's not going to be completely displaced by GBR, that's for sure, unless they completely undermine, go back on what they've said and have fair competition. If they have fair competition, Trainline's here to stay. I think it will continue to do very well for the next 2 or 3 years anyway. But if for me, one of the keys to actually realizing value in this company from where it is, cut the cost base and just generate the extra cash, pay down the debt. Very simple. Actually, I think the market would love that.
Brilliant. Okay, right. We're coming towards the end, Paul. So I just ask all my experts is sort of like, what's your favourite stock idea, underlined and bolded idea for sort of the next 12 months? Obviously, last time you mentioned sort of Greatland Gold and Boku. Obviously, Greatland Gold and fabulous. Anything we should sort of highlight for investors to sort of do the slide rollover?
I mean, you probably gathered it from my comments. I do think U Group will do very well in the next 12 months, and actually bizarrely, this affects Telecom Plus as well, which we didn't talk about. But the fact that the government's made such a pig's ear of the power prices in the UK, we're stuck with really high power prices. And once this big renewable new offshore wind gets signed, those are like 30-year agreements, which are going to keep our power prices very high. It's actually very good for the only way you can deal with that as a UK investor is buy some power suppliers, because high prices are good for them, and their high electricity prices will be good for all of the power distributors, because they just make a margin on the price. So yeah, I'm pretty bullish on both of those from that point of view. But U Group is lower rated and probably going to grow faster. So yeah.
Just in terms of sort of the Telecom Plus, I mean, I guess the fear is that, okay, once the power prices have normalized at this higher level, is there ever a risk that have been disintermediated by sort of the chatbot engines? Because you put in, okay, right, I want to renew my electricity, broadband, insurance, or whatever, house insurance, and all this sort of stuff. And then you just ask your chatbot, who knows that person, all personal specifics, where they live and all this sort of stuff, and then just comes up with a one-person answer. That's the sort of the fear that they get, because obviously Telecom Plus is an intermediary. Is that just impossible to do because they effectively buy the power forward, and it isn't as simple as just straight procurement?
I mean, Telecom Plus, is it an intermediary or supply? I mean, it is technically a power supplier. It's sort of out. It has a back-to-back agreement behind the scenes with to get that power supplied, so they don't have to worry over the long-term procurement of the electricity and gas. That's done by a much bigger. It's E.ON is it E.ON? I think so. And the same with U Group, who have a agreement with Shell to do all the procurement, because that side of it that's big company territory, but they are the supplier, so they're not just. They're not sort of touting just switch with us and they don't get the money out of switching, they get the money out of supplying. Yeah. And Telecom Plus does have a very quirky distribution model of selling through agents. So you become a Telecom Plus agent. It's a bit like network marketing, as it were. But it's been doing this for a very, very long time, and it's been good at it. The only question about it is how well does it scale up from here? And that's actually what the fear over Telecom Plus was: does this kind of network marketing reach a ceiling? And I don't fully know the answer to that, but I suspect it can carry on growing for some time. And the reason why the earnings have sort of flatlined in the past year were not to do with that; they were to do with the power prices coming down. So we're through the power price falls, and high power prices now are good for both companies. So yeah, I think Telecom Plus will still grow. And it's not in the same business as Money Supermarket, which is a whole other ball game. I don't really see that it's an AI issue for them. It's more about their overall proposition and how sellable it is, and can they carry on selling multi-utilities to their customer base.
Yeah, I was just looking actually, and it trades at roughly around about what is it? It's 11 times PE, isn't it? I mean, it's pretty damn cheap.
Very low. Yeah, absolutely. Yeah.
Brilliant. Okay, great. Well, that's a lovely one to finish on. And thanks again, Paul, for all your comments. And hope your back gets better after the weekend. But anyway, thanks a lot, and speak to you in 6 months' time.
Fantastic. Thanks, Paul.